Is Philip Morris a safer investment choice to Altria and British American Tobacco? Those two companies we have researched and analysed extensively on the channel, but Philip Morris, which has been under the radar, is a very strong company and has outperformed both Altria and BTI over the last 5 years, and we'll touch upon that. So in today's episode, we want to understand, is it a safer investment of your money over the next 5 to 10 years and beyond? And is it a buy now? We're going to take a look at the historical performance and analysis of Philip Morris International, jumping into their income statement, looking at their top line as well as their bottom line growth, revenue and net income. We're going to take a quick snapshot of their health, their balance sheet, their total cash versus their total debt to see how safe is that dividend. And as mentioned, we will compare them to Altria Group, BTI and a few others on a total return basis. And as always, we want to see what are the institutions doing? Are they buying or selling? And we're going to take a look at their latest investor presentation, highlighting one or two key aspects of this company that maybe Altria Group and BTI may not be performing as well. And we're going to take a look, as always, at those important dividend metrics, financial metrics, really understanding, is this a strong company for the next 10 years? And as always, we will run it through our stock valuation model, getting to our intrinsic value and finding that acceptable buy price given our margin of safety. Now, Philip Morris is in the tobacco industry, very similar to Altria and likely to BTI. It is down 14% year to date, so it hasn't had a great performance, and we can see it is at the 52-week low, offering a yield just shy of 6%, which is significantly under the yields that Altria Group, currently at 10%, and BTI around 9.5% are offering. So it does offer a lower yield, doesn't mean it's a worse option to take, but let's do a deep dive and take a look. Over the last 10 years, Philip Morris is essentially flat. Now that is very poor by any investment, although that doesn't include those dividends reinvested. Taking into account inflation, you would essentially have been losing your capital. So what we want to understand, over the next 5 to 10 years, can we see this share price double, maybe even triple, and see this yield on cost into the nice high double digits? So taking a deep dive into their income statement, and what we like to see on the top line is 3 to 7% growth year on year. 29.6 billion in December 2018, December 22, 31.7 billion. So there has been growth on the top line, not as fast as we would ideally like, that 3 to 7%, and we will look at the last 10 years percentage wise shortly too. In terms of an increase, well, they increased their top line very slightly in 19 before decreasing and then increasing again. So slight inconsistencies, but we do see increases on the top line, even though you could argue they're not beating inflation. Now, bottom line, 7.9 billion in December 2018. Latest annual report, 9.048 billion. So they are increasing their bottom line at a faster rate than their top line, which is positive to see. Again, on a more granular level, we do see a decrease into 2019 before an increase to 21 before relatively flat. So again, inconsistencies on the top line and bottom line. So do bear in mind with Philip Morris, this isn't a fast growing company, but that is what you would expect anyway in terms of the tobacco industry. It isn't the industry which is fast growing. Now, health check, total cash versus total debt. 6.6 billion worth of cash on the balance sheet in 2018. Latest quarterly report from a few days ago, 3 billion. So they are sitting on roughly half that amount of cash than they did 5 years ago. It's not necessarily a negative thing, but let's compare that to the movement and numerical number of their total debt. So when we look at their total debt, we can see 31.8 billion, and in their latest report, 47.8 billion. So a slight worry, they are decreasing their cash while also increasing their total debt significantly, and we will take a look to see how that affects the net debt to EBITDA metric, as well as that dividend safety. So again, we're comparing it to Altria, BTI, and a few others in the same industry. And what we can see on a total return year to date, Philip Morris is down around 10%. Now, it is underperformed Altria Group, but it has performed better than BTI, which has taken a massive hammering at negative 24%. As we can see, in fact, in the industry, JAPAY up 14%. So now let's look over the last 5 years and see how Philip Morris has performed in comparison to their competitors. And what we can see, well, that's very interesting. Over the last 5 years, in fact, Philip Morris has been the best performing stock in the industry, outperforming Altria Group as well as BTI and their competitors, up 28%. Now, yes, that isn't that great, 28% over the last 5 years. You are looking for a lot more, but it is positive to see if you are looking to invest in this industry. Purely based on the last 5 years, Philip Morris is the best performing stock. Now, as I always say, just because they've done this in the past, it's not indicative of the future, but it's always good to have as one level of review. Now, moving on to the institutions, and we can see institutional ownership of Philip Morris is sitting just below 80%. 6.84 billion worth of shares have been sold by institutions over the last 12 months. 14.4 billion bought, in fact, over the last 12 months. So institutions are buying a significantly larger amount of shares in Philip Morris than they are selling. And we can take a look over the last few quarters with the largest buy by institutions in Q2 at around 6 billion with 1 billion sold. And in fact, if we go towards the beginning of 2022, we can see institutions in general, in fact, are buying more shares every quarter than they are selling, with the largest purchase Q2 of this year. So again, it is positive to see. It is interesting as well to see what institutions are doing. But as always, you have to do your own due diligence and don't get caught up in what institutions are doing and follow blindly. Now, if we take a look very quickly at their earnings call, which happened a few days ago, we can see they have beaten on the earnings per share over the last 4 quarters. Looking specifically at the September quarter, we can in fact see the earnings per share expected. They did beat by 3.76%, with the revenue a very slight minus 0.6 surprise. So they are struggling slightly with that revenue, but we do see a very strong beat on the earnings per share. And if we just very quickly compare their September 23 to their year-on-year performance, top line, they have managed to increase that revenue by 13.81%, which is very positive to see. Unfortunately, their net income has slipped by 1.58%, along with the earnings per share. And then we can see that net profit margin, which isn't that great, especially when considering they have been increasing that top line by quite a significant amount. And their operating income, we can see they have increased. So some mixed signals there, some mixed information to read on. But on the top line, they have been increasing. It would just be more important for them to focus on increasing that bottom line net income too. But what is positive to see, they have been beating on that earnings per share over the last 4 quarters. Now, very quickly, before we look at some metrics, just a few things to know with Philip Morris. They are spending a lot of time and investment in essentially the smoke-free area and sector. We can see here the 2022 smoke-free net revenues greater than 15% in these 17 markets. And the main thing to take from here, this is 7 more markets than there were in the prior year. And one thing that can essentially show this on a better scale is that they are focusing a lot of investment, as we can see, in their smoke-free products. As this, what you could imagine with regulations, if you've seen the BTI and Mo videos that we have performed, a lot of regulation is coming into play with the UK, New Zealand looking to ban essential kids from smoking in their lifetime. So you could say this is a positive with Philip Morris, that they are doing more than, say, Altria. I know British American Tobacco are also spending a lot on the smoke-free product investments. So now moving on to the essential dividend metrics and dividend safety. We see a dividend safety score of 64, making it safe, with a market cap of 136 billion, making it a mega cap company. Now, for those that believe a recession is due, they did in fact increase their dividend over the last essential 07-09 period, and they had around negative 2.6% sales in the recession, but that was above the average growth of companies in the S&P 500, which was in fact negative. Now, in terms of their dividend growth, they have been paying increasing dividends over the last 14 years. We did have an increase last month of 2.4% and a 4% increase on average over the last 5 years, with a 5% over the last 10 years. Now, the reason why I don't like this 2.4%, I do always say minimum of 4% every single year is what you want in your dividends, your other income producing assets, as well as your salary, because the US inflation rate over the last 40 years was 4%. Anything less, you are in fact taking a pay cut and losing purchasing power. Now, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average, as we see here. First sign of undervaluation. But remember, we don't look at any model in isolation and draw conclusions towards the end. 13.8 on the forward PE below the 5-year average, another sign of undervaluation. And we can see the PE is below the sector PE of 18.1. Now, as I mentioned, is at the 52-week low, but bear in mind 52-week low doesn't signal undervaluation. Likewise, 52-week high doesn't signal overvaluation. Earnings versus free cash flow. New viewers need to understand we ignore the earnings. It is susceptible to manipulation by management through accounting, and we do show some examples across the videos we produce. So free cash flow payout ratio, what I like to see is 60% or low. The reason for this, in my opinion, it means management are able to offer those double-digit increases we love to see. But for tobacco industries where they do pay out the majority of their earnings as dividends, we are happy with around 80 to 90%. What we can see over the majority of the period, it has been around that 80 to 90%, 2022 at 80%, with 2023 expected 81%. So far, based on the information, that dividend does seem to be safe. Likewise, with the EPS, data is available for essential investors who like to look at it. Let's focus on the free cash flow. 551 in 2013, 627 in 2022, with 23 expected at 644. Now, it hasn't increased massively over the last 10 years, but this is a tobacco company, and as mentioned earlier, they aren't fast-growing companies. It isn't like they are going to bring out a product tomorrow, which essentially is going to drive their revenues higher and higher by double digits. So just understand what type of company you are investing in. But overall, it's still moving in the right direction, which is positive to see. Now, sales growth 3 to 7% is what we like to see, and as mentioned, with the tobacco industry, it does have its ups and downs. We do see, in fact, from 2013 to 15, the top line dropped from 31 billion to 27 billion, and then you can't really argue that it's picked up because it did go up to 8% before falling back down again. So when we do look at the last 10 years, 31 billion to 31 billion, there hasn't been any real movement on the top line, and you can argue with inflation that in real terms that revenue has been decreasing. Shares outstanding, yes, we love it as investors when companies do share buybacks. With Philip Morris, the essential, shares outstanding has remained relatively flat, so not much to discuss there. Now, ROIC, it is one of my 7 golden dividend metrics, and I do like to look for 10% or more in companies I invest. The reason for this, it means management are able to effectively allocate their capital, and we can see for the large part, 2013 to 2021, it has been very, very high. Even though it has dropped to 31% in 2022, this is still very high, and it does give me faith so far in management from what we can see. Operating margin, free cash flow margin, nothing much to say other than very, very strong across the board, both on margin of the operating section and the free cash flow. So very positive, no worries at all. Now, net debt to earning for interest, tax, depreciation, amortization, it was something I flagged when we did the balance sheet review. The reason for this, they did decrease their cash position over the last 5 years whilst increasing their total debt quite significantly. And this will ultimately affect the dividend safety and that payout that we typically get every quarter. So what this signals, the number of years it would take the company to pay off all of their debt net of cash on hand. And from 2013 to 2021, it was fairly positive, quite significantly below 3. 22 at 2.92 and 23 at 2.97. Is a little bit too high to that 3 that I'd like to see, but it is something for now that I would just keep an eye on and check from quarter to quarter to ensure there are no issues that we are seeing forthcoming. Now, as always, if you do enjoy the content, value is being provided, do hit that like button, do subscribe, and hit the bell to be continually notified of these videos. And if you want to grab a copy of the valuation model to get your own intrinsic value, your own acceptable buy price, given your margin of safety for companies in your portfolio, do click on the pinned comment below. Starting off with Graham's valuation, we have the stick symbol, the earnings per share, growth rate per analyst estimates, and that very high current yield on AAA corporate bonds. Bear in mind, the higher this current yield gets, the lower the intrinsic value will get due to the formula. So the intrinsic value for Philip Morris coming in at $82.50. We can see it's slightly lower than the current price, roughly showing some overvaluation of around 5 to 10%. But as always, remember, we don't look at any of these models in isolation and draw our conclusions towards the end of the episode. We then have the multiples valuation model. We have Altria, Universal, and British American Tobacco in the same industry, which we analysed earlier. Stock price, earnings per share, P multiples. We get the average, multiply that by the earnings per share of PM, and get a stock price based on the multiples valuation model of $41. Now, this is significantly lower than the current trading price by more than half, and it does show signs of overvaluation in the current market. But the reason for this, bear in mind that Philip Morris is trading at a PE of 14, which is significantly higher than that of Altria and UVV and BTI, as we can see here. So do bear that in mind, as some people can justify that higher PE for Philip Morris. Now we'll still include that with our intrinsic value calculation. In the dividend discount model, we have the yearly dividends year-on-year average growth rate of 2.66%. Now forward looking, I've gone only slightly higher than the average that we've seen. You could argue that is slightly optimistic. And as always, if you grab a copy of the model, you can play around with the percentages to get your own figures at the end. DDM price then with this estimate is coming to $107, very slightly higher than the 52-week high that we've seen not too long ago, showing signs of some undervaluation in the current market. Now we move to the fourth and final model, the DCF model, where we have our free cash flows year on year. Average growth rate around 6.5%, forward looking, analysts estimating slightly lower. And with that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, and we arrive at the equity value. Divide by the shares outstanding gives a DCF price of $118. As we can see, showing some nice upside to the current trading price above the 52-week high, and again showing signs of undervaluation in the current market. As always, the intrinsic value is just the average of these models we have just run through. And again, if you enjoy the content values being provided, do hit that like button. It really helps the channel grow. And do subscribe and hit the bell if you want to be continually notified of these videos. So our intrinsic value at $87 is essentially in line with the current price. So what we are saying is effectively the current market value is a fair value for Philip Morris. So depending on your margin of safety, this would depend on what your acceptable buy would be. At a 10% margin of safety, you'd be looking around $78. As we can see, that is significantly lower than the current trading price. Now, personally, if you believe that this warrants the higher PE that it is trading and is a better company to invest in than Altria and exactly BTI for reasons such as the fact they are heavily investing in the other sections of the tobacco industry, or if not, then this could be one that you completely avoid. Personally, it isn't one I hold. I do hold Altria and it is a significant part of the portfolio. But if I was to invest in Philip Morris, then I would be looking at a minimum of a 15% margin of safety at around $74. Now, it's not to say this won't ever happen. If we do take a quick look at the last 5 years, we can in fact see that it was at around $74 around the end of 2020. So it really depends on your essential analysis whether or not you believe this to be a company to invest in comparison to the others. Yes, on the last 5 years when we did take a look, it has outperformed both Altria and BTI. But again, it does depend on your investment thesis over the next 5 to 10 years and not what happened in the past. Wall Street do forecast the price over the next 12 months to hit $110. So they do see some nice upside to the current trading price. And remember, when you do invest in these companies and the stock price goes higher as well as their dividends, your yield on cost goes higher and higher. As always, let me know your thoughts in the comments below. Are you looking to buy PM, looking to sell, or purely on the sidelines speculating? If you do want to grab a copy of the model to run companies of your own to get your own intrinsic value or acceptable buy price, do click on the pinned comment below and grab a copy. And as always, if you want to join us in the Patreon, talking all things buys and sells in our Discord, then do click on that Patreon link below. As always, have a great day, take care, and catch you on the next episode. Thank you and goodbye.